Hey, Keshav, thanks for being here at Real Estate Development Land to Legacy.
Real estate development. Legacy. Real estate, real estate development. Real estate development. Land to legacy.
Let's jump right in. Tell me about what you do.
Yeah, thanks for having me on YouTube. It's an honor. So, I am primarily two things. I help people passively invest into private equity opportunities. Primarily, it's been multifamily real estate and ground up development so far. And in the interest of diversification and just balancing out your portfolio, which we look at from five different factors: appreciation, cash flow, tax benefits, liquidity, and risk. We're exploring industrial real estate, private debt, and oil and gas as well. So the goal there with the fund management is to build a diversified portfolio for our investors that has all these types of different businesses, delivering them the benefits that I mentioned. And it's paying them monthly or quarterly, regardless of whether they're working or sleeping or traveling, whatever it is. And the other half of what I do is build to rent development. Those homes that we have under development, I'm focused on underwriting there, on structuring the deal, raising the capital there as well, finding new deals, and then just putting systems together to scale a development company along with my partners.
So, when you describe yourself in like one or two words, are you more of a investor, capital raiser, developer? How do you short answer if you're like in a quick, I don't know, elevator one-stop run?
All of the above. And I don't know if I'm super proud of that answer. They're both very exciting. So I would say number one, just probably an investor. I think, developers are investors, capital raisers are investors. So
Where do your investors come from? Who's your typical investor? How do you get a fund put together?
yeah, so we operate a fund of funds where customizable fund of funds where we present 6 to 10 opportunities a year and across all of the different asset classes I mentioned, and hopefully more in the future. And investors get to decide on a case by case basis. Hey, I like investment one. I don't like investment 2 through 6. I like investment 7 through 10. And my investors are usually friends and family. They're people from work. I used to work at Amazon. Now I work at Meta. And I'm a software engineer. So I typically speak to a lot of software engineers, folks in tech, who I know kind of what their financial goals are, what roadblocks they're running into. And then social media beyond that.
Right. So the plot thickens. You're a software engineer at Meta, and you're also an investor. So for somebody like me and folks that I typically talk to, and some of the listeners on the podcast that are developing projects and who are looking for investors, I would normally prefer working with institutional investors or funds, somebody that can come in and have a group of investors behind them rather than working with retail investors individually. What are the types of things? So I'm thinking you're like my perfect person to pitch a deal to. But what are the things that you're interested in? What are you looking for?
Well, it's really, I try to balance those five things that I mentioned earlier. And not for I balance it for myself, but then each investor that we have, they have their own balance of where they like each of those five things to be with regards to their investment portfolio. And when it comes to development, at least, we typically look for a 20% IRR or north of it. And just, that's from a returns perspective. And then a healthy yield on cost, obviously, at least 150, if not 200 bips above where the market is right now. Beyond that, your typical underwriting criteria to make sure the deal's, conservative and you have some buffer for delays and running over budget. Besides that, and your criteria that you would apply to any private equity investment almost, who am I working with? What kind of market am I investing into? If it's real estate, what kind of geographic market am I investing into? And usually I'm in the built to rent development business, usually 100 units or more for economies of scale.
And so, how long is the typical time horizon of investments that you're looking to acquire or to invest into?
It could be anywhere from 1 year all the way out to like even 30 years. For example, one of the opportunities we're looking at, the minimum hold period of 1 year. After that, you can sell if you want. And I think investors always like that option to have in their portfolio because typically private equity opportunities lock up your money for 5 years, if not more. On the other hand, the 30-year opportunity, you get your capital back within the first 2 years or so. And at that point, it's infinite returns, right? Infinite cash on cash because you don't have any principal in the deal. So I would like to say capital back within 5 years, though, ideally. Just through the cash flow you're getting, refinances, etc.
Yeah. Can you give me an example of a project like that would have a 30-year time horizon where you would be able to get the capital out to yourself and your investors within the first couple of years?
Yeah. I personally invested into an oil and gas opportunity and I believe there's a working interest. I'm still learning about the oil and gas space, but I invested in it in November and it's been paying me pretty well. You know, the folks I invested with, they've been around for a few decades now doing this. Combining the tax benefits that you get, I'm not a CPA, but combining the tax benefits that you get with and the big thing there is the depreciation losses you get, you can deduct against your W-2 income, which for a lot of people in my boat, for example, at a tech company, we get paid pretty well. Taxes is always one of the biggest things on our mind. So combining the tax benefits and the returns that we get from the oil and gas being extracted and sold, we typically get our capital back within the first 2 years. And then at that point, though, I mean, some wells stay producing for 30, 40 years. Why sell the land if your principal's back to you? You could just hold it and it's just free mailbox money at that point. So that's one example of an investment like that's technically 30 years, but you get your principal back within 2 years. So you can do something else with the capital.
Interesting. And how risky is it? I don't know much about oil and gas, but is there a lot of risk compared to, ground up real estate, for example?
I think there's a little bit more risk. Again, still an area that I'm learning about, but this particular strategy, we go in to buy land only after we notice another big operator, another big driller is buying land in the surrounding area. So one way we mitigate risk, and specifically the risk of a dry hole, is we wait for a big producer to go in. We know that, if it's $1 billion company, they've paid their geologists, they've done their research to know there's oil and gas to be found here. So we wait for them to go in and, thousands of acres, if not at least hundreds. So you diversify your risk that way as well. It's not just a single point. There's multiple wells that you could drill. But you could still, even if there's oil and gas beneath the earth, it might not be commercially viable to get to that deposit of oil and gas. So I think that is a risk that you run in. No investment is without its risks. That's adding on to, I think, another thing that oil and gas suffers from that real estate doesn't as much is like global macroeconomics, I guess. That might be repetitive. But OPEC, for example, what they decide to do with oil prices affects us. And what wars break out across the globe, that affects oil prices as well. So whereas real estate, something that happens halfway across the world typically doesn't affect how much your apartment building is worth in like Austin, that's not exactly the case for oil and gas.
Yeah, interesting. And these are all onshore operations, or are these somewhere overseas?
The ones that I've seen so far have been onshore, like on land.
Can you say whereabouts?
Wyoming.
Wyoming.
Yeah.
Interesting. Yeah, that's one of the industries that I don't know much about. My father and my grandfather actually grew up in the natural gas industry, but I don't really know much about it. I've always been focused on construction and real estate. Interesting. So how do you decide what to present to your investors? So you've presumably done your due diligence, done your research, identified several different projects that you would like to invest in, and then you package it up and present it to your investors. Is that the idea?
Yeah, step one for us is always to hone in on what asset classes we're interested in. And from there, like for example, right now, personally, I don't know enough to go into office buildings, for example. And also, given the current environment, it sounds a little scary.
There
I'm sure
weren't.
people, yeah, I'm sure people are doing well in it, but I just don't know enough. And so, first is picking the asset classes, right? So, let's say it's
Mhm.
multifamily, let's say it's industrial real estate and oil and gas. Within that, we'll find anywhere between 1 to 3 operators that we really like who have consistent deal flow, at least 4 deals a year, I would like to say. My mantra recently has been to always have an opportunity for my investors. So, and I mean, I'm going to stick to that going forward. Then you have the sponsors and they're sending you opportunities. And at that point, and the sponsors we work with, they throw out most stuff that they find. So they already do a good amount of the filtering for us. And that's where it really matters who you partner with, right? If my partners, I can trust on their knowledge, their experience to weed out a lot of the bad deals out there. That's less work that I have to do than my investors have to do. From there, then I still do my own due diligence to make sure it fits kind of my risk profile, what I see in the market. And if I'm wrong about any of it, then I get clarifications from the operator who usually knows more about the deal than I do, as they should. And at that point, it's balancing like, hey, I presented 3 multifamily opportunities so far. Maybe it's time for another industrial opportunity. Or it's the end of the year and everyone's thinking about their taxes. Let's give them an oil and gas opportunity. So I try to keep it diversified with the investments that I'm presenting. And again, try to balance for those 5 things that I mentioned earlier, because each investor that you have is going to balance for different things. One investor is going to want the tax benefits a lot more. Another investor wants the liquidity. Another investor just wants the like high appreciation. So for the tax benefits person, I would send them to oil and gas. The liquidity, I would send them to some sort of, private debt opportunity, for example. And someone with like high appreciation, I mean, I would send them to either oil and gas or development.
How do you choose which project to invest into ultimately? Let's say you've got your 5 criteria and you've identified a dozen projects, all of which fit the criteria. What's going to move the needle for you?
Yeah, I think that would be a good problem to have, and especially in this market right now. Finding good deals with good sponsors has been difficult. Deal flow has been slow, and then sponsors have had capital calls or pause distributions, and that's par for the course. I'm not everyone's going to have a few investments that miss. Let's
Right.
say we did have 12 investment opportunities, though. I think for me, it would be trying to okay, one, I would make sure that we're not overly concentrated in any one characteristic of an investment, whether it comes to a sponsor, business plan, asset class, geography, like which market it's in. That's one thing to consider, just how diversified the portfolio is. Two, I would say what's the zoom out and like what's the macroeconomic environment looking like, right? Like right now, oil prices are $67 a barrel. It's lower than where it was back when I invested like 8 months ago, which I think back then it was $80, something like that. And so it's looking at that and how does that play into the picture? If I think $67 is too low, then I might just wait until oil prices come back up again and then invest. So I might pass on any oil and gas opportunities right now. The same thing with multifamily. If I see that there's still some way to go to hit the bottom, as far as foreclosures or more distress in the market, then I might wait there as well. It's also just thinking about what are the returns of each investment? What's the sponsor's track record? How conservative is each opportunity? Like how much room is there for error, things like that.
Understood. What about your own projects? You mentioned you're developing some build to rent properties. do you treat them differently when you present them to your investors, or do you still package them as an investment vehicle, sort of independently from the fact that you're also affiliated with the sponsorship group?
I have to legally specify that I'm with the sponsorship group. And then I think that also comes through in the way that I'm talking about the opportunity because I am involved in the day to day. So I'm just able to speak to a greater level of depth about the opportunity and how we put it together, the story, the risk mitigants, all of that.
Do you mind if I ask you a little bit more about the build to rent? Because I'm personally fascinated with that model. I'm assuming it's a single family build to rent.
We're going to start looking at doing some duplexes, like attached units.
Mhm.
Yes, for now it's primarily single family.
What I'm curious about is, and maybe it depends on the geography, and the overall style of the development. But I've looked at a few projects around here, and we're in Western Washington, Seattle area, and built to rent simply did not pencil at all. I could not get it to work. Reason being is cost of construction was so high, and rental rates did not correlate to sale prices at all. What I mean is that I could build a house or a duplex or a townhouse development and sell individual units for profit. But if I converted that model to a rental, it wouldn't pencil for me because the rental income that I would get would not be sufficient to cover the debt service that I would have to, with like a traditional split of, 70-30 or something like that, debt to equity. So I'm curious about the few projects that I've seen. I'm like, okay, well, we could probably rent it out for a few years and the rental income is going to be okay. It's not going to cover the debt service, but the real profit opportunity would have been from just hold it for 5 years, sell it, and then hope that the prices go up even higher. Tell me a little bit more about your model and how do you make it work and where those projects are located?
Yeah, so our projects are located in Louisiana and Alabama along the coast. That's probably one reason that construction costs are lower. And I would say that our land costs are lower too. We're buying land for between $50,000 to $60,000 an acre, raw land. Another thing I would say is our entitlement period is a lot shorter. My intuition is at least that the permitting process, the zoning process, regulations in general are a lot stricter in Washington than they are in Louisiana, Alabama. Construction costs are lower, land costs lower, the entitlement timeline. And let's see. I would say that also, at least the way our partners have, one of our partners is responsible for planning our communities. We build at a density of typically 8.5 to 10 units per acre, including amenities. We put a dog park in there. We'll put clubhouse, pool, walking trails, all of that stuff. And then our OPEX ratio it is around 35% usually.
Right. So if you were to compare cost of or just the price to sell that house versus keeping it and renting it out, is it pretty much equal toss up, or would you say a build to rent model is more valuable, more profitable than just build and flip?
For us, at least, like within the places that we're located, just with where home prices are, it's better for us to keep them rented. We like that it gets valued as a business rather than like on an income basis, rather than a
Mhm.
comparison basis. And then I think the other big thing also is the communities we're building them in, they also prefer that they stay as rentals rather than the single family home. Because if they stay as rentals, you have one property manager, you get to maintain the appearance of the community as a whole. Whereas if you left it up to individual residents, one house might look really nice and the other one not so much. So I think that's another aspect that has influenced our decision to keep these rented rather than sold.
What is the exit strategy with those types of developments?
It's to build and stabilize within 5 years of acquiring the land and then just sell it. Ideally, and get investor returns. Ideally, we'd like to hold the investments like the communities long term, manage them in kind of how we want to manage them, and build economies of scale in the same few markets that we're located in. But starting out, you're going to get the highest investor return for exiting to an institutional group who's looking for BTR.
Right. Let me ask you a few questions that I typically ask most of my guests, and feel free to ignore them if you wish. A few questions that I like asking are, where do your investors come from? You have this group of investors that invest with you. You mentioned friends and family. Those are typical go-tos. But beyond that, where do you find your investors?
Yeah, I would say family and friends is a big one. Just my network in general. I've worked at 3 companies now. Most recently at Meta, and so yeah, I've maintained a pretty strong network every place I work at. And beyond that, I would just say social media, just being active out there, posting content, creating educational resources, hopping on podcasts like these, like yours. We have our own podcast, so just providing content and attracting people through education.
Tell me a horror story, something that went really wrong with a project or an investor, something that you hated, but then hopefully it worked out in the end, or maybe it didn't.
Something that went wrong, especially as a developer, no way. Let's see. One that comes to mind, one of my first few capital raises, apartment building in Houston. We were in the middle of closing, and by the time we had actually closed, this was during 2022, the interest rates had went up a lot just in that summer. To the point where it went from being a positive leverage deal where the cap rate is above interest rates, cap rate above interest rates, to then interest rates being above cap rates and getting into negative leverage. So the original projections that we had made were no longer valid, right? And we had to raise even more equity. So that was fun. We had to change up our promote to make sure that when we talked to investors and projected X% IRR, now it's lower. So we had to adjust our promote to say, hey, you already committed capital. We're going to do the right thing, adjust our promote, and give you guys a bit more of the returns here. And I remember it was one of my first capital raises. One of my investors put money in because it was positive leverage. Then once rates went up and it became negative leverage, he actually asked for the money back. And so that stung a little.
What would you say? What was the lesson that you learned from that?
I think we couldn't have done anything better as far as executing on it. I mean, maybe we could have closed sooner, but I was just a fund manager there. I think we did the right thing by doing right by investors and changing the structure so that, hey, we projected this, things changed, even though they were not in our hands. You gave us your hard-earned capital expecting this projection, so we'll honor that.
So it's more of just shit happens, roll with the punches, and expect the unexpected every time you make a deal type of a lesson, right?
Yeah, and then know that you'll take a hit on this one, but think long term, do right by investors. They'll come back to you, stand by them, do what's right. They'll come back to you with their own capital and hopefully some friends and family too.
What is the profile of your ideal investor?
My ideal investor is usually a tech employee at one of these big companies, Meta, Google, Microsoft, and most recently NVIDIA. Someone who's in tech, they're too busy. They know that they want to diversify outside the stock market, but they're too busy to do so. They don't want to go buy and manage their own rental properties or anything like that. They probably live in one of these high cost of living areas, New York, Seattle, or the Bay, where if you want to buy a property, you have to really come out of pocket for it. And at that point, too many of your eggs are in one basket. So all these things considered, syndications make perfect sense for them because they can live in these areas make good money at these companies, but they could still invest in other parts of the country, like I have done. Wyoming, even though I've never been to Wyoming, Virginia, the Southeast in general, and also diversify across asset classes. You can become a residential investor, and that's fine. But if you really want to become sophisticated, you're going to need to diversify into other asset classes. And bigger pockets exists for buying single family homes, duplexes, triplexes. But just taking a guess here that buying an industrial warehouse might be a bit more difficult, or an office building, than a single family house.
It's funny. Obviously, I live in the Seattle area and know a lot of tech employees, Microsoft, Amazon around here. And a lot of my peers in capital raising, they say, don't pitch engineers. Engineers have this analysis paralysis. They will be analyzing the deal for a long time, and you'll never hear the end of it. How do you handle this?
Yeah, I usually approach it from, hey, I know where you're coming from. I fell into that trap myself, because when I started out and first learned about syndication almost 4 years ago now, it took me a year to get comfortable with the idea of investing into a syndication, something that wasn't publicly traded, publicly regulated, with people that I didn't know. What I would tell them is, you have to do your research for sure. I'm not going to deny that. You should do your due diligence on who you're investing with, what you're investing in, but also acknowledge that you'll never have all of the facts. You'll probably have 70 to 80% of it. And at some point, you do have to take action. So I remember wiring my first investment as a limited partner, and it was sometime in August of 2020. And that I remember thinking to myself, I might never see this money again. But at the same time, I had done enough due diligence to feel confident, and I acknowledged that all investments carry risk. And so, even though it was 2022 at the time, and that was a good chunk of change, you got to do what you got to do, or just be stuck where you are. So for me, being stuck where I was, 10% stock market returns, no tax benefits, relying on a 401k to retire, I just couldn't live with that reality.
So you had to come to terms that you are willing to accept maybe some of the unknown, some of the risk, but to diversify your portfolio and see that there are opportunities, while risk is still there, but have to get out of your comfort zone a little bit to realize that there are other opportunities.
Yeah, I would say the pain of staying where I was significantly higher than any potential cost I could incur by exploring outside of
Got
what
it.
I knew.
Right, that makes sense. Well, we're coming up to the end of our time. What else would you like to talk about, Keshav? Anything specific that you wanted to bring up? Any specific deals or any specific pitches that you would like to make? Go ahead.
Yeah, I appreciate it. Anyone who's out there listening, our goal is, again, I'm involved in two businesses. One, the single family home rental construction business, and the other one's fund management. So anyone who's looking to partner as a capital allocator, anyone who's a retail investor, especially tech employees, my fellow tech employees, I know how you think, I know what your challenges are, because I face them every day as well. Reach out, and I'd love to see how I could provide any value and work on something together.
Excellent. Keshav Kolur, thank you for listening or watching Real Estate Development Land to Legacy, where we talk to a lot of wonderful guests from the world of investing, real estate, and everything around it. Thanks again, Keshav.
Real estate development. Real estate development. Land to legacy.